Good evening, friends. This is Siddharth Bothra here. Thanks a lot for joining for this webinar. We will start off with our monthly performance ones, and then we'll come to the topic. So, if you look at the Ambit Coffee Can Fund, the last 1 month performance was roughly around 1.4% alpha, positive 1% versus the benchmark Nifty return of -3. If you see over the 1 year period, we have now around 2% alpha plus on a YTD basis, it's close to around 4% alpha. What worked for us in this month was these three stocks, which is KFin, which was up 16%, Concord Biotech, and Zomato. A couple of them which didn't work was, which fell during this month was Britannia took a sharp knockdown after the results. There was a promoter stake sale in ZF, which caused a sharp fall here, and then there were some uncertainties around insurance, where there is some speculation of some new rules around banca channel. So these were the three ones where we saw some corrections. If you look at the Ambit Good and Clean, again, there was a positive alpha. The returns were on the positive side. Here again, I think if you look at the 6 months, the improvement in performance has been very sharp as against the benchmark of around 8%. We are almost like 14.5%. Even on a 1 year basis, the returns are close to around 30%. The three stocks which did very well for us was Aegis, up 13%, Persistent, and Supreme. Whereas couple of stocks which kind of led to some pressure was PI Industries, Lupin, as well as AU Small Finance. If you look at the Ambit emerging portfolio, emerging small caps, here again, if you see the performance has been quite impressive when you look at it on a 1 month basis, whether you look at it on a 6 months as against the index returns of around 8%, we almost like 19.2%. So this improvement, if you see month on month over the last several months, has been continuing. And as the quality comes back, we expect this to accelerate. Some of the stocks which did really well for us was CCL Products, up 17%, Garware Technical Fibers, which was up 15%. If you look on a year since on a calendar year basis, it's up almost like 38-40%. And then obviously Mastic. A couple of one which didn't do that well was you had the Venus Pipes, Home First, and Rajasthan Global. Then if you look at our Ambit 10x, Ambit 10x again had a positive alpha of almost like close to around 2%. Here again, if you look on a 6 months basis, now the alpha is very sharp at almost like 9% plus. So here again, the improvement is very strong. The CCL, again, the main drivers here was CCL Products, Garware Technical Fibers, and Orchid Chemical. Whereas you had similar to names like Venus and PI, which led to some performance pressure on the downside. Now, with that behind us, we wanted to kind of discuss on the newsletter that we had for this month, which we christened as Pursuit of Pricing Power Plays. So as you know that in Ambit Coffee Can and most of our other funds as well, what we try and do is we try and find companies which have sustainable competitive advantage, which we believe typically shows up in some way in pricing power. So let's start with a small quote here, which is by Warren Buffett, which says that the single most important decision in evaluating a business is pricing power. If you have got the power to raise pricing without losing business to a competitor, you've got a very good business. So, Warren Buffett is known for quality, known for long-term investing. This is, one key message that they have around pricing power. So in this presentation, let's start with what we have done is we have discussed one of our core holding, which is up sharply for us and helped us in our performance is Zomato. And we discussed why we think it's a rare pricing power play. So we will quickly take you through. So essentially, if you see, most companies will have one of the two strategy. Either they are a low cost operator, wherein what they try to do is they try to have a cost which is lower than the industry average, and because they have this advantage, they can sell at a lesser price than industry. And here you would have companies like Avenue, Interglobe, who have the lowest cost advantage. Similarly, then their average companies, which are more or less their cost is similar to industry, their selling price is similar to industry, whereas there are some differentiators who maybe have marginally higher cost, but they benefit significantly from higher prices, where you have players like Titan, Nestle, Eicher, HDFC Life, Metro. Now, so the key thing we wanted to point here is that typically you will have a company focusing on one thing, either differentiation or low cost. Very seldom do you find a company which has distinct advantage on both end of the value stick, which is both they are able to price higher as well as they are able to enjoy lower cost. So why is it so? So what we have done is, like, if you look at Zomato, it has two key business. One is food. Now, if you look at the food business, if we were to do a Porter thing here, a Porter analysis, you see the millions of high income or middle income users, and they are willing to pay for convenience. So on the buy side, you have millions of people. Again, the other leg of your consumption, like other leg of your transaction is the restaurants, where again there are lakhs of restaurants. Many of them are unorganized, and they have very low bargaining power. Similarly, when you look at quick commerce, it's a poor infrastructure cities, underdeveloped trade, and brand advertisers are today finding it a better ROI thing. So on willingness to pay, they have significant power. If you see, hardly 2 3 years back, they never used to even charge us delivery charges. Today, they've taken take rates up to almost like 25 26%. They charge you almost completely for delivery, and at the same time, they continue to grow at upwards of 20%. This is in food. Similarly, same thing happening in the quick commerce also. So if you look at the cost side, the key cost actually for a food delivery or a quick commerce is the bikers or the delivery people. And the key advantage which was trying to explain here is the cost advantage they have in bikers, where almost all bikers for them are on a contractual basis. So your biggest cost is a contractual thing, and they are available in abundance, and it's relatively inexpensive in India. So again, these bikers don't have too much of a bargaining power, because there are only two players in food and three or to five in quick commerce. Then again, there are lakhs of restaurants. The same thing here, lakhs of companies. So you have a bargaining power on both ends. Now, obviously, on the food vertical side, they benefit across. That is, on the substitutes, it's weak. Threat of entry is weak. Buyer power is weak. Similarly, the rivalry is very low. If you look at between Swiggy and Zomato, they're both trying to be profitable. There's no pricing war between them. Both of them increase the platform fees slowly to 10, almost 10 to between 6 to 10 rupees. And similarly, on the cost side, there is not much rivalry. So the food vertical for Zomato looks clearly something which is very attractive, and their margins here could expand a bit more from here. And this is a business which looks like a steady cash cow with more than 20% kind of a growth outlook. It's the quick commerce where we think they are in a stage which is similar to where food business was, say, 3 to 4 years back, where competition is increasingly increasing. And when we do a Porter's analysis here, it looks like the threat of entry is high, but what people miss is that the minimum economies of scale here is still very high. So though the threat of entry is high, that is, a lot of people may be coming in, the minimum economies of scale is high. Again, the buyer power is strong, because there are more and more QC players coming in, which is quick commerce players coming in. Substitutes is also increasing, because earlier you had players who were e-com, who were slotted delivery. Now everyone is trying to do quick commerce. So this segment, if you see, is not looking so attractive. But why are we still positive on Zomato? Is because if you look at it, earlier the quick commerce business was like almost like, if you look, $3 billion last year, which will be more like five and a half, six when we close the year, because it's growing 100%. Now, this is a business where initially you thought the total, what you call the TAM, which is total addressable market, was, say, maybe roughly 15 18 billion. But as we see, what's happening is all the three are converging, which is your e-com, your slotted delivery, your quick commerce. So while competition is increasing, the total addressable market is increasing very sharply. And within that market today, actually, the way to look at it is Zomato is not being disrupted. They are actually disrupting the e-com players, the slotted delivery players. So, the way the traditional way someone would look at it is this is the industry where they are, he's an incumbent and others are coming and threatening him. But the reality today is that these guys are in a way threatening the e-com players, the slotted delivery players. So we think despite this competitive intensity, because the total addressable market is increasing, we remain positive, and also because we think Zomato has some key advantages here. We'll come to that. What are the key advantages they have? So if you look at it, the key advantages they have here is, say, if you look at the pricing side, they firstly, with regard to their own competitors, they have a significant advantage in the food business where they get higher take rates, their advertisement income is higher. And on the QC side, it is more visible where the advertisement income for Zomato is significantly high. So, on the assortment side as well, Zomato is like significantly higher at around 600 plus, whereas many of the competitors are like 300. So, the average order value for Zomato is upwards of 600. For others, it may be around 300. So, again, this is a key advantage they have. Advertisement income is typically we see in this industry that, whoever has the leadership, who has more than 50% market share, they get disproportionate market share of advertisement income. So again, Zomato has a key advantage here. And the other advantage Zomato has is the cost side, where they have synergy benefits because they're in the food business and there's organic profit from there. And they're able to leverage it, unlike other players who have now two business models, or who don't have a profit making segment like the food delivery. Here I mean someone like a Zepto. The other key advantage for Zomato is the regulatory and financial cost advantage. So if you look, the rules for domestic and international, the foreign players for retail is different. Now Zomato is someone who's like very close to being domestically held. It's almost like 50.1 or 50.23 something the last I saw. So if they were to become a domestic company, and if in future regulatory hurdles or regulatory challenges were to increase, Zomato should be in a sweet spot. Whereas, most of the competitors, like if you look at the very big ones like Amazon, Walmart, they will continue to be a foreign company unless, they decide to sell below 50%. Similarly, other competitors, they have very concentrated investors, whereas for Zomato, the concentration of investors is very diffused. So, what we wanted to kind of highlight here is that, when you look at a company like Zomato, not many people view it as a pricing power play, because you think of pricing power, many people think of pricing power as, say, a Nestle or, some of these companies like a Titan or, similarly, as I mentioned, HDFC Life or similar companies like maybe till some time back, you would even say Asian Paints and so on. So, these players today have established it and they have already proven, whereas this is in the very early cycle. So if you see in terms of where do you make the maximum money, our study suggests that the maximum money is made when you find one of the businesses where pricing power is just emerging. That is, it's not like proven and people have not yet understood that there's a business with huge pricing power. So we think Zomato is in one such phase, and it's a core holding for us, and almost like more than 140% up for us. So, when we talk about pricing power, another thing I wanted to talk about is that, there's a perception that is the pricing power thing something, which we just talk about in India, or how does it happen? So there was a research paper done by, there's this player called, who did a research paper. He's a Bloomberg scholar who did this research paper, which is called Pricing Power Everywhere. So they took data from all the geographies, which is US, Europe, the emerging Asian economies, the larger Japan, China, all the economies. And they found out that the period between 2007 to October 2023, across these verticals, a portfolio which would have been constructed based on companies with pricing power would have outperformed the respective benchmark for that particular geography or country. And not only did it outperform, it had significantly lesser drawdown. It had beta which was much less, and it was more a stable kind of a performance because the volatility for these portfolios was lower. So this is kind of reflected in, if you look at the returns, since 2007 to 24, even in times when, the US markets have fallen sharply, like say 22, the fall in the pricing power index stocks was only 5%. So our portfolio is, we take pricing power based kind of companies, and that's one of the key things we try to focus on. So these were the 2 points. Now I want to come to the third point, which if you've been following us over the last few months, followed some of our other monthly reports, we have been talking a lot about it, which is the style divergence, which was there post-COVID, and how this style divergence is now reversing. So this exhibit, I think, in a way, kind of captures what we are trying to say. If you look at the period post-COVID, which is FY21 to, we think this period kind of was behind us in September 24, or maybe even after the elections itself, between June and September. This was a period which was characterized by very high beta stocks, a risk on sentiment, a momentum-led short-termism. There was market was very broad-based and it was very theme-driven. We think this market cycle is now reversing, and the some of the characteristics which an Ambit asset management stands for, which is low beta, capital protection focus first, a long-term driven mindset, concentrated portfolios, and a bottom-up bias. We are not like a top-down investor looking at themes and trying to identify stocks. We are more bottom-up investors. So from that angle, we think this reversal of investing style should be very favorable for our style of investing. And if you look at the entire history, you have very small periods where you will see this kind of a market existing, where you have a very high risk on sentiment, very high beta, and typically the time period for these kind of markets is typically not more than 3.5 years. So as you see, we are now reaching a phase where we think this kind of a reversal is not only there but going to accelerate to our mind. Now, what would drive this reversal, and how should we see it? Now, this is a very interesting exhibit from Ambit Research, institutional research. What they have shown is that, when you have a period where market is very broad-based, like this period from November 22 to say maybe somewhere around November 5, what we typically see is that the mid and small do sharp much better because market is broad basing, and during that time the large caps don't do that much. So if you look at this period, large cap return was 42%, versus mid and small being like 62. Similarly, you see this period green, which is 2009 to 10, the mid and small was almost like 93, 95. Then we come to this period from November 13 to almost like November 17. Here again, the CAGR return of mid and small was 30 and 33%. We think we saw something similar, which is, post-COVID till November, where the returns for mid and small was like almost between 14 to 12% higher than the large cap return. Now, what happens when this kind of a broad-based rally reverses the way, we are talking here? Then what happens is you see the reverse. Then let's look at the yellow lines here. During the period November 17 to roughly November 20, the large cap return was positive too, whereas mid and small was a CAGR of -8 and -15. Then if you look at this period between November 10 to November 13, the large cap return was almost flat at -2, whereas the other two, which is mid and small, was like -9, -14%. We saw the same thing happening between November 4 to November 8, where the returns for mid and small was almost like -11 and -15. We think this kind of a phase is now starting, and you will probably see something similar happening in the next 2-3 years. So this should be very positive for companies which are more focused on quality. I mean, portfolios which are more focused on quality and on leaders and companies with high pricing power. So that should be the key positive, and also to an extent, companies which have higher, more heavyweights or the large cap. Now, what are the other triggers which could be driving it? So this is the data that we took from Kotak Institutional Equities desk, where they talked about how the earnings differential was expanding between the top 100 market cap companies, the market cap from 101 to 250 and from 250 to 500. So if you see, the earnings differential was very high between this second quarter 2024 to next, where the mid and small went up very sharply, whereas the large cap didn't do that much. Now, if you see, the last quarter which ended, actually the segment which is 250 to 500 saw a sharp fall down versus the other two. So this again suggests that the resilience in a market which will become tough, in a market where economic growth may be slowing, earnings may be slowing, large cap resilience will stand out. We see the similar thing in the cuts in the FY 25 and 26. If you see, the large cap cuts have been relatively less versus mid and small cap. But the way we do portfolios is we are house which is like looking at a very select group of companies which have the characteristics of significant competitive advantage, quality, and we are not so much in some of those theme driven or the other segments where some excesses are visible. So whether we are a large cap, mid cap, small cap, this is the small subset of market we look at. And if you look at the sales, EBITDA, and PAT growth for us over this period, it clearly stands out for most of our portfolios, including a coffee can, whether it be Good and Clean and the other funds, versus say this is the returns for the benchmark. The third point, which I think will trigger the kind of reversal that I was talking about, is the fact that, while market is still, very exuberant about the fact that we have close to 25,000 or, 30 to 40,000 crore, 25,000, 28,000 coming in SIP, and overall inflow of around 40,000 odd crores coming in various ways from retail and so on in the market. What market is probably not giving enough attention to is that the supply is increasing in a much significant way. So, both in 24 and 25 now, the total equity supply is actually exceeding, the kind of a demand that we have for, equities through SIPs and so on. So if you look at FY 25, the total equity supply is almost like 7,50,000, of which just the promoter secondary sales is 1,50,000. So promoters are what you call insiders, and they know the company much better. And if you just anecdotally look, many of the promoters or company have been in a rush to raise capital or sell stakes, whether it's private equity. So, of course, one can view it as markets are favorable. So you're raising equity growth capital, or, private equity and all are sitting on good profits. They are selling, but it is also a reflection of, markets being very robust in valuations. And, this is a market where, a lot of these insiders are finding it a good time to cash out. So if you look at the overall supply seems to be increasing, and it's going to be a key risk to the kind of a rally that we've been seeing in the last 2, 3 years. Now, lastly, if you look at the valuation divergence, the valuation divergence, whether you look at on a market cap to GDP, whether you look at the PE differential, a lot of these things are suggesting a lot of excesses happening in market. And I'll come back to this. The exhibit that we had. We think all this will lead to this. So the core investment philosophy or the characteristics that Ambit Asset Management stands for, which is the low beta. Our first focus is capital protection, rather than try and think as to, before we think of what kind of a return, this is the first thing, whether our capital is protected here or not. Then the other is the long-term investment mindset, the concentrated and bottom-up. I think these things, which have been a bit off fashion in the last 2, 3 years, is coming back in a big way. So with this, I kind of have completed the 2, 3 things, the 3 points that, we had in our newsletter. First being, talking about how pricing power is one of the key things to identify companies which can give you stable long-term returns. And we discussed Zomato within that. The second point that, this kind of a strategy works worldwide. And there's been studies done which suggest that in each of the geographies, if we would have followed a pricing power strategy, it would have beaten the indices. And the third point, which we mentioned, which we've been mentioning for some months now, that we think the investment anomaly which was there is reversing, and this should favor our Ambit asset management style of investing. So with this, now I'll hand it over to my colleague Trilok, who's our macro expert here, and he'll talk about the macro and market update. Over to you, Trilok.
Thanks, Siddharth. Thanks for taking us through the perspective. So I will quickly take you guys through what's happening around in the economy, because we think eventually the earnings slowdown that we witnessed in the quarter gone by is also a function of what's happening around and picking up in the economy. Undoubtedly, this is very, very surprising for most of us that the GDP fell to 5.5%. I think the nearest estimates for the GDP number for the Q2 was 6%. And I think this is a surprise, or I would say a rather shock for the economy to report such kind of low numbers. In fact, to the expected lines that this will have a bearing of 50 basis points on the full year basis. We will get into details of what led to that growth slowing down. Moving to next, if you look at, apart from the fact that there has been a moderation in the capex from a public capex YTD, but urban slowdown, which is very, very prominent around, is also a function of what is the household debt. The leverage in the household is, bank is gone back to 2007-8 levels. In fact, is up nearly 50 percentage points from 32% to 43% in the last 4 years. Also, thanks to the personal loans as well as the advances to individual, and the credit card receivables have been the biggest driver in the EMI burden for an average household. So if you look at the broader numbers, the average EMI burden has doubled in the last 2 years and gone up 4x in the last 7 years. And as RBI also was indicating, a large part of the personal loans is been diverted to either home renovation or overseas travel, or maybe he's also finding some ways into capital market, which is also why the narrative driven rally was happening in calendar year 23 and to some extent in this first quarter of the financial year 25. So I think the urban slowdown will necessarily be a function, the growth will be a function of how the real income growth happens, and which is exactly the next slide talks about. The real challenge is, apart from the EMI burden, and the total expenses going up, the urban wages is also marginally risen in this particular in the last year versus the preceding year. In fact, if you take a longer term picture between 17, 18 and 2023, 24, the real wages, is only up by 1%. From a 5 year CAGR, the number has been quite sort of subdued. Whereas rural wages obviously is down during the same period. This is obviously, being released by the periodic labor force data on an annualized basis. So we think the real question is the urban slowdown, or to some extent, the pickup will be a function of how the real income wage growth, particularly in the urban and rural market, picks up going forward. Moving ahead from wage growth to what's happening around the hiring, front. In certain pockets of hiring, we are obviously seeing growth, in terms of high single digit to double digit. Particularly, the buzzword around is AI, artificial intelligence, and machine learning. That's being the driver of the employment in the country. And oil and gas, thanks to large projects coming upstream, is being a driver of the hiring across the country. But this is obviously a data released by Naukri Jobs Peak Index, and they release on a segmental wise, sector wise perspective. So broader level, you see there is obviously a job not being created to the extent what most people anticipated. And if you look at a 3 month rolling sort of averages for these particular data, banks continues to sort of have a moderate net addition to the workforce. Particularly AI and oil and gas, and to some extent metals are actually driving the workforce addition. So this particular trend also has to reverse for significant growth to come back, particularly in consumption. However, amongst all the relatively gloomy news, I think so the silver lining prevails in the rural front. So two, three important aspects that we see on ground. The water storage is obviously very, very strong, similar to we saw in the last Rabi. In fact, higher than the last Rabi, and also in line and greater than last 10-year averages. Notably, real rural wages have started to showcase positive uptick in the last 4 months. In fact, since FY21 till maybe first half of 24, you had seen 0 to -% of the real rural wages, which is a very testimony to the fact that the net increase that you earn after the inflation covering up your expenditure has been flattish. The good news is in the last 4 months it is reflecting a positive growth, and which is also reflecting in some extent some tractor sales reversing, two wheelers doing well, and we had rightfully played that positioning of the two wheeler by playing Bajaj Auto in the coffee can and also looking at TVS in the good and clean and in portfolio. So I think there is some signs of recovery, particularly on the rural front, which is a positive read through and which is a silver lining in the overall growth that has been moderating. And we believe this particular recovery is great news for the second half of the economy and subsequent FY26, because rural is one engine which is not fired for the country for the last 2 years now, and this is very imperative for the contribution of the rural markets to move up if we want the GDP growth rate to sustain a 6.5-7% going forward. With that, I would like to comment my, sort of remarks on the macro front. On valuations, so we obviously want to not speak too much, but valuations remains in the long-term averages. And Siddharth had already highlighted couple of pockets and areas we have seen some stretched valuations, but attuned to our style of investing, I think so. Businesses who will not deliver earning growth and businesses who have only was led by narratives were the one which will be the most impacted. And portfolio like us and the style that we invest with should be the big beneficiary, given the move of mode of market changing towards strong quality and the growth versus the momentum and the cyclical that we saw in the subsequent last 12 months.